what does it actually mean to think differently? It might mean that you think differently than you have before, up to this point in your life. Maybe a different mentality, a different attitude. It definitely means thinking differently than the majority of the crowd, thinking differently than the majority of Americans think about money. It absolutely means thinking different than what is being taught by financial institutions and the financial advisors, planners, agents who are basically pushing exactly what financial institutions want. And then lastly, it means going against your natural tendencies. So we're going to talk about each of these in a lot more detail as we go along, and hopefully that will strike a chord with you in some way and help you with your finances and help you improve in your financial outlook. You know, we've all heard this phrase a million times: insanity is doing the same thing and expecting a different result. So that's kind of what we should focus on here as far as your mindset goes. David, in your experience in working with people, how much time do you think most Americans spend, thinking about money, dealing with their finances, learning about money? What would you say to that?
Most of us prefer to just have it and not have to think about it or worry about it, right? Go to work, make the money, pay the bills. Can we go on vacation kind of thing?
And I would say that a lot of times the reason somebody focuses on finances is when something negative happens, right? Maybe they have an emergency or some big medical cost that comes up, or something breaks down that they need to fix on their house or whatever, right? So it becomes a big issue, and all of a sudden we need to focus on our money. We need to get serious about this, and deal with it. So I think, would you agree that most people are pretty reactive when it comes to their finances instead of proactive?
Yes, very much so.
Okay. So so just before this webinar, I was looking up some statistics, and I found this statistic: that how much time does the average American spend on personal finances? The research that has come out says that only 3% of Americans engaged in financial planning daily in 2022, and that's a decrease from previous years. And actually, the trend, if we go down here, the trend is that people are spending less and less time dealing with their finances. Not a good trend. When they get older, that's when they start to focus on it a little bit more, which kind of makes sense. It's a little bit of still reactionary, right? They're suddenly 65, right? Or they're getting really close to 65, which is retirement age, normal retirement age. And so they're feeling all this pressure of, oh my gosh, are my finances in order? Do I have enough money to live on for the rest of my life? And so it's that kind of crisis financial management that's occurring right there. So I thought that was interesting. Money is something that has an interesting way of forcing itself upon us, doesn't it? Can we just ignore it and be fine, David?
A lot of us try to go through it that way, but eventually, I think we've had a lot in the YOLO, you only live once, that mentality that's become more and more prevalent over the past 5-10 years, which is normally what we shout right before we do something irresponsible financially. Right? So it's like, that money's for our future. It's like, well, YOLO, let's go to Cancun,
Yeah. So. I mean, it's an issue that, you think about married couples. I mean, how many married couples, if you think about this, how many married couples that you've worked with express that one of the most valuable things that they're getting from doing planning with us is that they're on the same page for the first time, yes. Or that they're talking about it in a, atmosphere that isn't negative, accusatory, or, it's not.
Or emotional in general, right? Someone
right.
wants something, someone is pushing back on it. Yes.
So money is one of those things that, it's like gravity. Whether you like it or not, it's going to affect you. And, the best thing you can do is not to ignore it, but be proactive about it instead, and kind of face it head on, and figure out how to deal with it. Let's talk about one of the first things that people can do to have a little better mindset or change their thinking. Let's talk about following the crowd. Are there times when following the crowd might be a good thing?
Yes.
Can
When
you
going to
put any
Chick-fil-A. Right.
Okay, so if you go the opposite the direction of the entire line of cars, what's gonna happen?
Right. It's not going to be good. That's right. Yeah,
You might accidentally take somebody else's order, and you'll definitely get in a fight.
that's right. Yeah, people
So,
get passionate over that. That's for sure.
yeah. So are the majority when it comes to things like money, are the majority of people going to succeed, or in other words, are they going to become financially free at any point in time in their life?
No, no. I remember a picture on the wall, and I never understood it as a kid, but you memorize the quote and all that. And it was a picture of some rocks in a stream. And it was a quote by Thomas Jefferson. It said, in matters of principle, or in matters of taste, swim with the current, and in matters of principle, stand like a rock. And I think we confuse what those are. What is actually just a taste, like Chick-fil-A or something like that. Maybe what movies we're going to or whatever. But with principle, we kind of equate money to just a tasteful thing instead, and it kind of leads us along with our tastes instead of what should be guiding those decisions underneath.
I love that imagery of the rock and the stream. Here's some statistics, I think, or a statistic that I think tells us a lot. So, based on the Retirement Confidence Survey, which the survey is done every year, surveying thousands of Americans across the country, some that are retired, about half that are retired in the survey, and half that are still in the workforce. And of the people who are retired, 67% of the retirees say that Social Security income is a major source of income. So what could we take from that alone?
They're not well prepared, right?
Yeah.
If that's what they're relying on as their major source, even at the maximum level, it's not very much.
Yeah. If something's major source of income, it's probably more than half, or at least it's extremely vital
Yeah.
to being able to survive or pay for their lifestyle, right? So I think that's kind of telltale, right? Two-thirds of all the retirees are saying that they're basically dependent, in large part or maybe even entirely on a government program, Social Security retirement. So what leads people to that? I think that's something that we should start thinking about. What is leading two-thirds of the nation to be totally dependent on Social Security? And are we doing the same thing, or are we doing something different than the majority of the people, right, that are ending up in that situation? Probably, like you're saying, when it comes to principle, following the crowd, especially when it comes to money, is probably not a good thing, especially when, just based on the surface, we all know that the majority will not become financially free. Most of us have heard of the term herd mentality. And there's actually been quite a bit of research done on crowdthink or groupthink, pack mentality, mob mentality. Those are different terms that are used for that. There was a pretty famous research study done in the 50s, and the experimenter placed a single participant in a room with four other participants. The four other people were undercover accomplices. So they knew what the experiment was all about, and they were told to kind of give certain answers. They were given a sheet of paper that had lines on it, and they were supposed to say which two lines were the same length. And the accomplices were told to give the wrong answer and to kind of collude, and they were all going to give the same wrong answer. And the purpose of the study was to see, what is this, participant who wasn't an accomplice, who wasn't told what to do, how would this participant respond? And surprisingly, 1/3 of the time, that participant gave the wrong answer. And the right answer was obvious. They made it very obvious. So the only thing that was changing their mind was that the majority of the people in the room were saying it was something else. How can we, how do you think that applies to finances?
We don't like to be alone. A lot of us don't want to do what's different from everyone else. We don't really like it when we're challenged on a lot of stuff from other people's opinions, like, what, you're not doing this? And it's like, it makes me feel like I'm off on an island alone. That doesn't sound very good, unless you're fishing, I guess, right?
Yeah,
Yeah,
I
we
mean,
we
being a
we feel like I think of zebras, and zebras, they have those stripes to kind of protect them when they're with the herd, but when they get separated, that's when they get really in danger, you
right.
know. And when we feel like that, I think a lot of people feel like a zebra out there, and they get separated from the pack. And it's like, whoa, I don't like this. So
Yeah. So it's kind of ingrained in us. And if you've read Atomic Habits, James Clear talks about how it's kind of probably part of our DNA, where, early on in humankind's history, like if you were cast out of the village or you were cast out of the cave, that was kind of a death sentence. Like you were going to die if you were cast out. I think we've kind of held on to that. It's been ingrained in us long enough, over millennia at this point, that we want to be a part of the group, part of the crowd. Well, what would be a problem with herd mentality, or is there a problem? Can there be a problem with herd mentality?
well, going back to the Chick-fil-A example, it might taste good in the short term, but it's probably not, as much as I don't want to admit it, it's not good for my health long term. Right? So I think normally the herd is very emotional and very skittish, you could say.
I used to be a duck and goose hunter, and if you're hunting geese, with geese, there are when there's a flock of geese in a field or they're on the water, there's always a bunch of them that are kind of eating and they're doing their thing, but there's always a few of them around the edges that have their heads straight up and they're constantly just looking. They're not feeding. They're constantly looking for danger. And but when they give the signal, the entire flock just suddenly stops whatever they're doing and they fly away, right? And that's served them well. How much are the other geese thinking? That are just eating and suddenly they hear the alarm, so that's the big problem with herd mentality, is that not that it's always wrong, or not that it doesn't keep us safe in some circumstances, but what it does do is it pretty much stops us from thinking for ourselves, right? We're not evaluating things for ourselves. So that becomes a problem, especially as it relates to money. And then you combine that with some of the information we've already talked about, which is the
Probably,
majority.
Kyle.
Yeah.
Oh, yeah, probably the most stark contrast or example of this is even in the world of finances. Most people who have been financially successful, those that we know that are really not just living off of Social Security kind of thing, but doing whatever they want kind of thing. When we talk to them about what they actually did, you start to see a consistent pattern where it's not what the herd is being told to do. Therein lies the key.
Well, I also see things like, as we go through the planning process, one of the areas that we cover would be like auto insurance, right? So we're talking about auto insurance. And one of the things that we ask our clients is, how did you decide the levels of coverage that you have on your auto insurance? And what is the most common answer that you get, David?
That's what I've had. That's what I had on my parents' plan, and it's what I've had for the last 20 years. It's what the agent
Yeah.
says.
That's what they gave me, you
Yeah.
know? And as they say those words, I think in most cases they realize that's really not a great answer for themselves, right? I don't tell them that. I don't say, well, that's a terrible answer. Um, but I think that they feel that way. I think that they feel like, wow, there should be a better reason than me just, this is what they gave me, or this is what I've always done, or this is what my parents did, you know. Um, so those are all kind of examples. I think following the crowd, the point is if you're following the crowd, then really you should be questioning. You should be pausing and saying, well, where's the crowd going? And what are they doing? And am I doing the same things? Because if I'm doing the same things, then I'm probably going to get the same results that they're getting. And those results really aren't probably what I want to have happen at the end of my, career or whatever it is throughout my life. So let's talk about financial institutions. So do financial institutions have a big influence on what we hear, what we're being taught, maybe what's popular financially?
I'd say so.
Okay. I mean, they have quite a bit of money, don't they?
Yep. A lot of our money. Right? Yeah.
I mean, every large city in the United States and maybe throughout the world, you look at the tallest buildings there, and who usually owns them?
Yeah, some kind of financial or investment firm or something like that. Yep.
Yep. So they have a lot of money. They put a lot towards marketing. And is it sometimes hard to differentiate marketing from, the real, like, what is good advice?
Yeah, they
Okay.
can appear very much the same, especially when it's repeated often.
Yeah. It's a little bit like Chick-fil-A. It looks really good. And might not be good for us, but it looks good.
Yep.
So let's kind of dig into financial institutions a little bit. What is it that financial institutions really want? Do you suppose that any financial institution is saying, "Hey, how can we help David and Leah become financially free? How can we give them more money?"
Doesn't seem like that's the case. No,
What do you think they really are doing then?
they want to be able to get control of our money.
And most likely the products, not just most likely, the products and the strategies that they promote are designed to help them do that. Isn't that true?
Absolutely.
Now, does that mean financial institutions are evil, that we don't want them, that they can't be helpful for us in any way?
No, 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 not at all. I mean, they're selfishly motivated, and we would expect that, right?
Yeah. They're not charitable institutions, is what you're saying.
Not that I'm aware of. No.
Yeah. Now, what about the person who might be listening that says, well, I've got a great banker that I think that banker really cares about me, or I've got a really great insurance agent and he comes to my kids' baptisms and he, sends me birthday presents, stuff like that. I mean, can that person really care about the individual?
Absolutely. I got three older brothers that were all in the financial institutions realm, and each of them would care about things, but it's interesting how oftentimes like their quotas and what their income is tied to is on pressing and pushing different products. That's exactly what the financial institution wants.
Yeah,
Right.
absolutely. At the end of the day, they're for profit, right? They're trying to make a profit. That's the bottom line. That's what they're trying to do. They're not trying to make you profit. They're trying to make them profit. And they're trying to make them financially free and not necessarily you. How can we tell? Like, what's some evidence that financial institutions, and I'm not saying the individuals who work for them, but the financial institution itself doesn't really care about the individual? Can you think of any scenario where they prove that that's the case?
Gosh, I think of the GameStop and AMC stuff that happened a couple of years back,
Yeah.
right? And they really smothered the little guy from being able to capitalize on that. Um, in fact, I remember watching a Super Bowl commercial for Robinhood right after that whole fact, and it was like, "Hey, we're for the little guy, robbing the rich, feeding the poor," kind of thing. I mean, that's the whole point behind Robinhood. But then when all the little guys kind of combined, they put restrictions in place to help out their buddies and to hurt the little guys ultimately.
Yeah, they're like, hey, these guys are trying to play the game we're playing. We're not going to allow individuals to do that, right?
That's right. Yeah.
I thought of a scenario where somebody has a mortgage. Let's say they get a mortgage through their bank, their lender, credit union, whatever, right? So they have this mortgage, and let's say that they get cancer and they become super sick and can't do their job anymore. So they lose their job. They're on, let's say they even have a good disability plan. They're getting 65% of their income replaced. What is that lender going to do if that individual can't make payments anymore on the house,
They'll
or at least
foreclose.
for several years?
Yeah. They'll take the house.
They're going to take the house. And is that kind of a terrible time to send somebody out on the street?
I think that goes without saying. Yes, absolutely.
Yeah. I mean, they will actually take the person's house, right? And they'll even push them potentially into bankruptcy, and all kinds of things. And that's regardless of that individual who you might have worked with, who really actually might care about you, who helped you set up the mortgage. Isn't that true? Yeah. So at the end of the day, it's the financial institutions and their purpose that overrides maybe any intent of the individual who works for them. So we kind of have some rules. We teach all of our clients the rules of financial institutions, and these rules that we teach are really kind of the guidelines, so to speak, of how all financial institutions create products, and really helps helps them determine what they're going to push, right? What they want to be popular. So what's the first rule, David? What do financial institutions, all of them, and I'm saying insurance, Wall Street, banks, etc., what do they want us to do with our money every time we get paid?
It wants to give as much as we can to them.
Yeah. So they're behind the scenes coming up with new products, right? Every time. It's just like clothing companies, right? They want to come up with new designs, new trends. And in fact, they kind of push new trends just so that people will get rid of all their old clothes and buy new clothes, right? So financial institutions aren't really different than that, right? They're going to come up with new products, new things that they're going to push out to the public because their goal is to get our money on a regular and ongoing basis. How long do they want to hold on to our money?
As long as they can, like forever, right?
Okay. And why is that? I mean, the longer they hold on to our money, what happens?
Because they're able to make more money with it the longer they can have it, the more they can use it.
The more they can control it, right? And use it. And if they have to give back something, what are they going to try to give back?
As little as possible.
Right. So they're never out there saying like let's go back to the disability example, right? As soon as that person doesn't meet the definition that's required in their policy for being totally disabled, what's the insurance company going to stop doing?
They'll stop paying the benefit.
Okay. What if that person still needs more money? What if they're not on their feet financially yet?
If it doesn't meet the contract and there's no provisions in there, then they
cut them off,
stuck.
right? So let's dig a little bit deeper into this too. Let's say that somebody is securities licensed, a securities licensed rep. Okay. So what that means is that they can sell stocks, bonds, mutual funds, variable securities, okay, to the public. When they communicate with their clients, or when they put out marketing material or even information, like if they were doing this webinar, what would they have to do before they send that out to the public?
Get it approved by legal.
Okay. Yeah. They actually have a department and officers in that department called compliance, right?
Yes.
And that sounds a little bit like 1984, doesn't it? Where the only thing you're allowed to say is what the institutions allow you to say. Isn't that what compliance is?
Very much so. Yep.
Yeah. So that's one thing that's interesting. That's one thing that I would point out with Unique Advantage, that we don't have that restraint because we are not securities licensed. And really for that, that's probably the major reason in my mind why we aren't securities licensed, because we don't want to do what the financial institutions want us to do. We don't want them to tell us what we can or can't say. I don't think a lot of the public knows that that's actually the case. Do you think that's true?
Very much so. And that it's not in their best interest then to promote anything other than the securities. They got licensed so they can manage people's money, so they can make money. And so if they recommend other things outside of that, they wouldn't make money off of it.
That's important, I think, to know. Again, we're not trying to vilify financial institutions. Hopefully you don't walk away from this webinar thinking, man, these guys are anti, insurance companies, anti banks, anti whatever. We're not. We just think it's valuable for you to know that maybe financial institutions don't have your best interest at heart, that they have a different agenda than you have. And just having that piece of knowledge will cause you to pause and say, hey, you know what? This seems to be a very popular thing that's being pushed a lot, and there's a lot of marketing for this. Maybe I should think twice about this. Maybe I should dig into this a little bit more to find out what's happening, or, why it might be a good thing, instead of just hurrying and flying away with the rest of the geese. Right. All right. So let's go to.
I think what you're kind of getting at there too, Kyle, is really, I mean, we've kind of lost the art of critical thinking. we have a lot of kids, but we also are even weirder than that. We homeschool them. But a big reason for that is just to teach them to think critically about things. So when they come up against anything, like just asking, well, why is that the case? Or do we just take it at face value? So whether it's eating at Chick-fil-A, or whether it's the mortgage stuff, or whether it's the auto insurance, well, why do I actually have this coverage? What's the purpose behind this stuff to begin with? It's asking those critical questions of all of that to help us, to just enlighten us so that we can make better decisions for us, because we have to look out for ourselves ultimately.
Yeah. I mean, don't you think that financial institutions would love us just to send money to them and not really question anything?
Absolutely.
Yeah. Yeah, I think I would agree with that.
Yeah.
All right. So let's go to this picture. So this kind of represents our natural tendencies, right? As human beings. Maybe not all of us. There's probably some on this call that are like, they wake up and they're so excited to eat perfect every day and drink all the water they're supposed to drink. And the first thing they do is run 6 miles, and they just love it. They just can't even live without doing that. That's probably not the majority of people though, right?
No.
Okay. And in fact, for most people, if we think about health, right, physical health, if we just did what our bodies or what our natural tendencies were, what would happen?
Ooh, it wouldn't be good. Sleep too long. Yeah, we wouldn't care about other people. We wouldn't care about things. All those things. We're naturally selfish, naturally lazy, kind of thing, right? That's kind of the
Yeah. Yeah. Do we
that's where
like
the water
comfort?
flows. Yes.
We like
Yes.
comfort. We kind of avoid pain. We like comfort. We want to do what's easy. Um, how does that affect us with money?
Yeah. I think it reminds me of those. Is that the Staples commercials with the easy button?
Yes.
Right. It just reminds me of that. I think a lot of people would rather do the easy button. In fact, I was presenting to a bunch of people a couple of months ago, and one of the gals there was like, "Oh, when it comes to investing, just do whatever, just make it easy on me." I was like, "There we go." that's,
Yeah.
that's how we want to think about it. I'm already busy doing all this other stuff. I just don't want to think. I don't want to take on something else.
Right. And I think that's absolutely true, right? It for most people, I think, first off, lack of physical health is a financial burden. Ultimately, it becomes a financial burden. The stuff that leads to lack of physical health, which is probably most commonly in the United States, is probably eating out, right? Fast food and stuff like that, right? And not exercising. But if you think about the things that lead to financial success, you know, a lot of times if we do what's natural, or if we do what's convenient or what's comfortable, then we're probably not going to control our spending, right? We're not going to take accountability or take responsibility for our financial situation. We're going to constantly be looking for the easier path on investing or saving or anything that requires less effort, less knowledge, less sacrifice on our part. Is that really, you know, uh, when I look at what the financial world, and I would blame actually the financial world mostly for this false choice that's being presented to people, which is, hey, there's the hard way to make money, which is, you could start a business and you could hire employees and you could take the risk, you borrow money from the SBA and potentially you lose, right? Potentially this doesn't work out and you invest a lot of blood, sweat, and tears into it. But the other alternative that the financial world is trying to present is, oh, well, if you're not willing to do that, then just send us $1,000 a month, for the next 15, 20, 30 years, and you're going to have the same result. I mean, isn't that really in a nutshell what the financial world is trying to present?
And
Okay.
it's an easy sell for most of us, right? It's like, hey, I'd rather I like that option.
Have you ever been on vacation somewhere and someone comes up to you and they say, "Hey, I'm giving you, here's this free bracelet, or here's this free flower, or here's this free picture, painting, or something like that." Have you ever seen that happen?
Yep.
And what goes on in your mind when somebody comes up to you with that?
I guess I'm more skeptical on that stuff. And I'm like, what's the catch here? What are you going for, buddy? Right?
Yeah. I would say that probably everybody on this call has that same thing happen, right? They have that, "Hey, what's going on? Nothing's really free," right? So we get this red flag that pops up that says, "Hey, nothing's really free. There's going to be a catch here. I'm actually going to ignore this person and walk right past," right? And so my question is so first off, do we really think nothing is free? Is that a principle that we believe in, that nothing is really free, or the opposite of that, that anything that's worthwhile requires effort, time, sacrifice, those kinds of things?
Yes, absolutely. I think about that a lot, actually. And I mean, anything that's worthwhile and repeatable requires effort and work and discipline. Sometimes people get something, there's people that win the lottery, right? There's people that get lucky sometimes in the markets, right? But it's not something because of something that they did or something that they could repeat again either.
Yeah, we call that March Madness.
Yes, that's good.
So why is it that when it comes to money, though, people kind of suppress that red flag? Like when they say, "Well, I'm going to get a free match. That's why I'm putting my money in a 401k," or even just the idea of I can just send my money to somebody and they're going to take care of me. And by the time I'm 67, I'm going to have enough money. Why doesn't that same red flag pop up that says, "Hey, something's fishy about this. I don't know if this is right. This doesn't jive with, what I think about free things and everything else in every other area of my life."
I think it goes back to kind of our society in general, and the financial institutions have driven that home that, hey, you can do that. It probably goes back to like just after World War II with pension funds. And when employers started offering pension funds, which kind of did that to a degree for people, they'd put in their 30 years and then they'd receive, 60, 70% of their income for the rest of their life. We still do it in the military, thankfully. I'm glad we take care of our military members in such a way. But otherwise, what happened was pension funds can't actually work that way with what they were offering. That's why all the private industries have gone away from it. The only ones that still offer the pension funds are the government positions, because they don't have to be profitable. They can just tax us more.
Yeah.
Right. But we get in our mind that, oh, well, we'll have this stream and that we'll be okay. And it doesn't really require a lot more work or effort on our behalf. When really the rules of the game were changed once companies started going away from that. But we didn't really adjust the herd mentality at all. The financial institutions just shifted where the money was going, but all the risk was now on us.
Right.
Right.
Yeah. Huge difference. Right. And
Yeah.
it was downplayed significantly. In fact, they kind of promoted the idea that, hey, this is actually better than a pension because you can get potentially higher returns over time, and pensions have
Absolutely.
to be invested very securely and all that kind of stuff. Right.
Yeah. And you'll have control. If you leave your employer, you get to keep it, versus with the pension, you lose it. Right. That
Right.
kind of thing. Mm-hmm.
Yeah. I don't know if a lot of people on this call know this, maybe some do, but what actually led to the legislative act, which was called the ERISA, that was passed in 1974, what actually led to that was pensions failing. It was pensions failing, and people were clamoring for something different because they had these pensions and then they would go to retire or were about to retire, and the company that they were working for filed bankruptcy just to get out from under the obligation of the pension.
Yeah.
Or even when they were retired, once they're retired and they're receiving benefits from a pension, they're legally obligated to pay it unless they file bankruptcy, which we've seen tons of companies across the country do that just to get out of their pension. General Motors, a number of years back, did that, right? The entire cost of their operation on an annual basis was lower than the amount of money they were paying out in pensions. every year to retirees. So they got out from under that. So pretty scary. And like you're saying, they just kind of swapped where the money was going and put all the risk on the employee instead of the employer at that point.
Well, that's, I mean, for the dynamics for those on the call, the ERISA is the Employee Retirement Income Security Act. And so one clear telltale sign of what's going on with any legislation is read whatever the title means, and then they're actually going to do the opposite of that. So it was to secure the pensions, but then companies just wanted to get rid of them rather than paying the tax penalty. So then that started that whole promulgation of that from 1974 onward. Yep.
Interesting.
Yeah.
So Booker T. Washington, who I think is one of the great American heroes, he said this, and he if you haven't read his autobiography, Up from Slavery, fantastic book. It's an amazing story. He was actually a slave, and then he became a free man and became very successful and really focused on educating the Black people who were freed. And but this is a quote that I have on the wall actually behind me. It says, "Nothing ever comes to one that is worth having except as a result of hard work." And I would just say that is true, that's absolutely true. There's no scenario where that doesn't apply, including money. And so I would encourage us to adopt that and think about that, or maybe remember that as we're making financial decisions, as we're faced with investment opportunities, or we're making those kinds of decisions. If we keep that in mind, I think we'll make better choices. Ray Dalio, who Taylor quoted early at the introduction of this webinar, in his book Principles, another quote of his in that book says, "Without principles," which I believe what Booker T. Washington said is a principle, right? But he said, "Without principles, we would be forced to react to all things life throws at us individually, as if we were experiencing each of them for the first time. If instead we classify these situations into types and have good principles for dealing with them, we will make better decisions more quickly and have better lives as a result." So I think the bottom line of this part of the presentation is that, if we're looking for the easy path, if we're just giving into our natural tendencies, then we're probably going to end up where most people will, which is highly dependent on the government and highly dependent on kind of charity from other people. So I think thinking differently is realizing that the easy path doesn't exist, and that reaching and maintaining financial freedom requires time, effort, sacrifice, knowledge, all the things that actually, we know to be true in all the other areas of our life, right? That if we want to have enduring success, those things are required. Okay, well, let's talk about a couple more specifics. I know we have like 10 minutes left before we get into the Q&A. So my goal isn't just to rush through everything. I want to cover some of these things, and we may not get through all of this. Again, we're going to have webinars every month, and we would love to have all of you back and to continue your learning. And hopefully you've found value in this so far, and that you continue to find value in it. I want to talk about some specific things that I think will help us in the idea of thinking differently that leads to financial freedom. See this image, in the middle of this image is net worth. And really the idea behind this is that financial institutions and most financial advisors and planners out there are saying that this should be our goal, David, that we should be shooting towards a certain amount of net worth. Sometimes they use the word nest egg, or sometimes they use, different terms like that. What does net worth actually mean?
Net worth is just your assets minus liabilities.
Okay. And
right?
does that necessarily mean like income from something?
Nope. No,
Okay.
technically it's value, right? What
It's a
value?
value. Okay.
Net value, you could say.
Is it actually possible to have millions of dollars of net worth and no income at all?
Absolutely.
In fact, do you see that oftentimes with people that you work with?
Yes, actually, I was joking with the client the other day. He has like student loans and his house and all that. I mean, it's like 1.3 million in debt, but he just passed the point where his net worth is positive, right? And we were joking about it. The biggest reason was because the value of his home has gone up, but he's not
Yeah.
making any more money. There's nothing else that's producing income to him.
I mean, what if you have a net worth of $5 million, David, and you go into a grocery store and you fill your cart with all kinds of stuff, right? Like everything you want to buy. Because let's say you're worth $5 million net worth. When you go to check out with that cart full of groceries, will they let you walk out of the store? I mean, do you just tell the checker, "Hey, I'm worth $5 million, so
Yeah.
you
Put it
need to
on my
let me."
tab, right?
Yeah,
Yeah. Right. Nope. Doesn't work well.
yeah. You actually have to pay them, right?
Absolutely.
I kind of thought about this recently. What if you worked for somebody? Let's say you were an employee for a company, and the employer came to you and said, "Hey, David, instead of giving you a paycheck every 2 weeks, we're just going to send you a paper, and on that paper, it's going to tell you how much money you're worth. And every month, we'll just send you a new paper, and you'll see how it's growing. And what do you think? I mean, that would be pretty cool. What do you
Right.
think?
You increase your net worth real well. Right. That's right.
I mean, who would be
Um,
satisfied with that?
no, no one who's working probably. Right.
So why do financial institutions push this net worth as the objective? I mean, do they do that? Do they seek net worth, or are they more concerned about something else?
They don't care about net worth, I don't think. No, but they push it to us, I think, because it goes back to the rules of financial institutions. They want our money and they want to hold on to it as long as they can. And so the less that we use it, the more we just leave it there and build our net worth, the more they can turn around and use it over and over again.
So like the employer who's trying to convince you that net worth is a good idea instead of a paycheck, um, if they could convince you that that was good, then what does the employer get to do with that money?
They get to hang on to it.
Yeah. So it works out in their benefit, doesn't it?
Yep. Yep.
But you can't actually pay your bill. And in fact, based on the statistic that we already talked about, 67% of retirees depending highly on Social Security. Why are they even retired? How did they have the guts to make that choice to retire?
I think a lot of it just has to do with age nowadays.
Yeah.
I've earned the right at a certain age.
If
Yep.
they weren't getting that check every month from Social Security, would they retire?
Probably not. Nope.
No. Out of that 67%, very few of them would stay retired, right?
Yep.
So what actually matters, and here's another interesting thing. Let's talk about businesses. So we work with a lot of business owners. How many of our business owners? I mean, one of the things that we ask for, that we try and figure out with the client, is how much their business is worth, right? Do most of our clients that are business owners know what their business is worth?
Nope.
But do they know how much income they're getting from their business?
Absolutely.
Pretty clearly, right?
Yep.
So which one
Yep.
actually matters to the business owner very much, especially the business owner that's not trying to sell their business, right?
Yeah. The cash flow matters more than anything. How much
Yeah.
revenue, profit, loss. Yep.
So this, in our opinion, is really kind of a false goal, right? It's really not a great goal. We're not saying net worth is terrible. You shouldn't have a high net worth, but we're saying that this doesn't equate to financial freedom, does it?
No.
I mean, think about this. If you owned a house, let's say you bought this super expensive house, it's worth a lot. Let's say it's worth $10 million, your house that you live in. Does that mean you can retire because you have $10 million worth of an asset?
No.
Does that mean you're financially free? You can do whatever you want?
Nope. Not at all.
In fact, the only way you get that money is what?
You have to sell the house
Sell the house. But let's
or
say you want to live
refinance it
there.
or something. Yeah. Yeah. refinance it and have a big payment on it then, right?
Yeah.
Yeah.
So net worth doesn't necessarily equate to financial freedom. And tied to that, let's talk about retirement a little bit. This is also part of the mindset, right? I think a lot of people think about retirement like, hey, when I retire, I'm going to be able to travel and I'm going to be able to do what I want when I want. I'll be able to spoil my grandkids. I'll be able to visit my kids wherever they live in the country. I can do what I want at that point in time. Is that really true for most people who are retired?
No, unfortunately.
So what does the word retirement mean?
It just means to stop working or to stop that work that you were doing.
Yeah. And are you taking that from your own thought of what you think it means, or where are you getting that from?
That's the definition of retiring. But I think of like an NFL player, or an NBA player, sports, they'll retire oftentimes early, but they still go and do something else afterwards. They just retire from that occupation, right? Or retire from the military at a certain age.
So does that affect people if let's say that they have this goal, which by the way, this idea of retirement is really pushed on us by who?
I think the financial institutions.
Yeah. In fact, you
Yeah.
you can't find a financial institution that doesn't talk about it, right?
No, not at all.
Doesn't exist. In fact, they promote it like it's the goal, right? That's the most important objective is retirement, and everything else. If you're going to sacrifice anything, that's the last thing you sacrifice, right? Is
Yep.
retirement. You could sacrifice liquidity, you can sacrifice insurance protection, you can sacrifice anything else, but don't sacrifice retirement. So they make that very clear that that's the main objective. But retirement just means to quit. It means to quit active working life, and it's based on an age. And we know the results for most people, 67% are totally dependent on the government for their living. Can people be retired but not financially free?
Yes.
And can people be financially free but not retired?
Yep. Absolutely.
So those things really aren't the same thing.
No.
Okay. And so let me ask you this. Let's say you wanted to bake a cake, David. And so you go to the store, but you buy mac and cheese box, right? With the ingredients for mac and cheese. What are you going to make? Are you going to make a cake out of that?
It won't taste much like a cake, right? So,
At least
that's
not
right.
what you expect, right? So a lot of
That's right.
times the problem is, and the importance of this discussion, or the reason we need to think differently, we need to think about financial freedom instead of retirement, is that if we're thinking retirement, then we're buying the ingredients for retirement, right? We're going to put into our plan the things that lead to retirement, which is not a capability. That doesn't mean you're financially free. So we may end up not being financially free because we bought the wrong ingredients. So I think that's the importance of making sure that financial freedom is your objective and not retirement. Retirement is imposed on us by the financial institutions, and there's a big reason for that. All right, Taylor, do we have any questions from anybody yet?
First question we had was, how do you talk about money in a family context?
David, you want to tackle that first?
Ooh, man, there's a whole bunch of different ways, I guess, to go through that, right? I think from our perspective, one thing that I see, I get a kick out of it sometimes. Sometimes I feel like I'm almost a marriage counselor. Not a marriage counselor, but it's because I don't want to deal with a lot of those things. But it's amazing how many times we have discussions with our spouses, and I'm the husband. There's nothing I can tell my sweet wife Leah because I'm her husband, right? If I tell her she looks beautiful, it's not until her friend tells her that she believes it, right? So and likewise, right? We just kind of interacted with those things. So I think sometimes, or oftentimes, when we go through things with clients and they see the principles, then it helps give a common ground for people to talk about together. It can be disconnected from emotions, and then they can address topics from the principles instead of maybe where they were thinking or whatever they were thinking. And hopefully they can come together and say, well, is that a true thing? Are we going to follow that? Great. Then how do we best do this? So in a family context, I think that can be helpful. If you're talking about teaching children, I think learning the right principles is helpful. And then I have my kids read a lot of books. um, you know, Rich Dad Poor Dad is a fun one. Man, I had my 14-year-old and my 12-year-old arguing the other day while they were brushing their teeth, and the older one says, "Sam, you don't even know what a real asset is." And it was like, right, that's a good insult. So it was like, when low blow, right? Be nice to your brother. So it was a little dorky, I guess, in that context. But I think there's good lessons that we can teach to children along the way. But more than anything, it's setting the right example for them.
Yeah, I love that. That's what I was going to say, is that the way you live, if you're the parent, right, the way you live, the way you handle your money, when you're saying no to things, even though you could afford it, the kids they'll take note of that kind of stuff, right? And there are certain principles that I think you've got to teach early on, because most kids at some point in time are going to earn money. They're going to start to earn money. And so teaching them things like paying yourself first, which is the first principle we teach our clients, having them get into that habit of, hey, every time I get paid, I'm going to take some of this off the top and set it over here in this other account. And that's money that I'm not going to spend on just fun or lifestyle, right? I'm going to keep that. That's money that's going to work for me throughout my life. One of the great books for that is Richest Man in Babylon. Another thing that's really good that I like is playing games. And there's a few games. Obviously, there's Monopoly. There's some of the other games, but they teach things, and some of them teach more than others. One of them that I think is really helpful is called Cash Flow 101. That's by Robert Kiyosaki. He's the author of Rich Dad, Poor Dad. And actually, he and his wife created Cash Flow 101 before they wrote the book, Rich Dad, Poor Dad. And his entire purpose of that game was to teach financial literacy. So it's a fantastic game. They even make an app for it now on the phone that you can use to keep track of your income and balance sheets. And it's really awesome. It's a fun game. I mean, I like it. I like money games. But yeah, your example is probably the most impactful thing that you can do.
Lanny Adamson asked in the chat, at what moment did you feel confident in taking risks?
So one of the areas that I was going to talk about tonight, but we didn't have time to get to, was anti-fragility. If any of you haven't read the book Anti-Fragile, I would recommend it. I think it's a great book. Mr. Taleb, who wrote the book, he coined the term anti-fragile. Basically, anti-fragile is different than resilient. We know what fragile means. Fragile means easily broken, and something that breaks easy, right? Resilient means something that resists breaking. Anti-fragile means something that benefits from negative impact. Okay. It doesn't just resist damage, but it actually grows from it. It gets better. And so, Lanny's question about taking risks has everything to do with that. I think the reason most people don't want to take a risk is because they're so afraid of failure, right? And we've been kind of trained to avoid failure. A lot of our education system teaches us to avoid failure, that failure is bad and that you've got to avoid it. And so we kind of get into this regurgitating memorized answers so that, we get it right. But the learning, I think if I were to ask everybody on this call, when do you learn the most? Do you learn the most in your successes or in your failures?
In the failures.
Yeah. And I think almost everybody would agree that that's where you learn the most. Well, so not that we should be seeking out failure, not that we're trying to lose money, so Lanny's question is, when you feel confident in taking risks, risk is the propensity for loss, right? So it's not that we're seeking to lose money, but what we should be seeking to do is learn, right? One of the things I was going to point out in this conversation tonight was how the attitude of most billionaires is that you could take away everything that they have, all of their assets, their business, their assets, all their money. And guess what? They all have the attitude that they could rebuild it in a shorter period of time and probably even to a higher level after that. Okay. And so that's the mentality that I think we should have. Their attitude, their mentality is to fail fast. It's to fail forward. They don't look at failure as, oh my gosh, this is a catastrophe. I lost everything, right? What they do is they look at it like Elon Musk does. Elon Musk looks at when his rocket blows up and he says, oh man, that was great. We're going to learn so much from that. You know, when the rest of us would be like, oh my gosh, we just lost millions of dollars, you know? So it's a total different attitude. The problem with most of financial planning is, when do you find out that it failed? At normal retirement age. It's designed for you not to know whether it worked or whether it failed until it's too late. So that's why our planning isn't using retirement accounts and using things like that, you know, we'd rather people invest in their own ideas, their own business, their own property. You find out pretty quickly if the ingredients that you put together make a cake or they make mac and cheese.
I think another aspect maybe on that one, Lanny, is just defining where the risk is actually coming from. You know, typically the less we know about something, the more risky it is. With anything, whether that's a relationship or dating or working on a car or doing a business or any of that kinds of stuff, or investing. And so when we start to get knowledge and wisdom about a subject, our risks in making a mistake or an error in that area go down dramatically. So I think where you feel comfortable or confident in taking risks, I think there's some different ways to gain that knowledge. One of the big ones is through reading books and blogs and other people's experiences, which we are huge proponents of. And then another area where we can gain a lot of experience or knowledge is through actually experiencing things then too. So, and that can be, you know, not necessarily jumping out and doing something really big that's going to fall big. But you take smaller risks to begin with, and you kind of dip your toes in some of those areas that you've learned about in the books, but now you're beginning to experimentally test the waters, and you'll learn a lot of lessons really quick with that too. You get more connections, and then our chances of making bad decisions decreases dramatically again.
Yeah. I would say also that just in connection with that there's a big difference between taking calculated risks and gambling. That those aren't the same thing. And I think most people are being taught, you know, risk equals return. You should take as much risk as you can tolerate, right? In fact, that's what traditional financial planning teaches. And most of the time people are simply gambling, right? They're putting as much money in as much risk that they have no knowledge and no control of as possible as they can supposedly tolerate, right? And we're saying that that's not what real risk taking when it comes to investing looks like. Real risk taking looks like, hey, I've evaluated everything I can about it. And in fact, the word invest means to cover completely. So it means to really investigate. You look inside and outside, you find a mentor, you read books, you do all the things you can do up front, knowing that you're not going to know everything until you start doing it, right? It's like you can't learn how to fish by reading a book only, right? But you know, you can learn a lot that way. And then you go into it not totally blind, right? Which is what most people are doing, unfortunately.
Yeah, that's a fun question. Thank you, Lanny.
Yep.
Okay, we have another submission from a registrant. This is a pretty broad topic, so you can take it however you want. But they were wondering about investing in college and funding college and FAFSA tips. So that's a lot of things. You can pick which ones you want to go in, but investing, funding college, FAFSA.
All right, David, you lead us out on this. David is we're lucky to have David in unique advantage because he is extremely knowledgeable about student loans, and which I think is very connected to this question.
Gosh, fast food tips. Maybe the best one is have your kid get married so that they don't need to declare your income then, right? Um, there's a lot that can go on there with funding for college, and maybe is college the right thing even at this point, right? Um, Gosh, that could be a whole discussion in and of itself. So I think the common financial philosophy of the day is you go through a 529 plan, which gives you a little bit of a tax break on your state taxes if you invest in your state's 529 plan. All of that money goes into the stock market, into mutual funds. And as long as the market's going well, that's fine. I think that's kind of tricky because we don't know where the market's going to be at when our child is actually going to college. And if it drops, okay, well, that might help in your FAFSA approval, but all of that money counts against you with FAFSA as well. So, and so that's a negative on how that goes. There's other ways to go about on those pieces, but I mean, the FAFSA is basically, it's for a child, it's going to be looking at their parents' income. And if their income is up high enough, then they don't get approved for grants, or they don't get approved for certain things. So I think looking at college in general and what's the best way to actually approach that. I've seen clients with tons and tons of student loan debt after medical school. Like I'm talking 600,000-700,000, and I've seen clients that have 100,000. And the difference is really like the client and how they lived, where they decided to go to school, how they decided to live, living at home, trying to be able to do it on the cheap. But a difference of 500,000, and they both have medical degrees, and they both end up making the same amount at the end. That's a huge difference. So almost more than just the funding of college is, what are we actually funding here? Maybe you do technical school and you get your associate's degree at a local community college for a way lower rate. And then that associate's program will probably transfer to just about any university in the country. And then you can still have the undergraduate degree from that university. But you don't have to pay for 4 years at that university. So I think there's some other, again, thinking differently about this, and how could we strategically think about that in some other ways than just, oh, you want to go to that college, that's the best college, I have to do it this way.
Yeah, I'd like to add a couple other things. I think one is, the idea of investing in the market, which is typically something that people don't have any control or influence over, and generally they're not an expert in. I always thought it was a little bit strange that somebody would invest into something. They're trying to fund their kids' education. And be responsible. They're saving. In most cases, they're actually trying to save, and that's the term that they use, the word, when actually they're putting the money at risk in the market. But again, it's groupthink that makes it kind of suppress the red flag on that. But I always thought it was strange that anybody would want their kids' education funding to be a maybe. And what I mean by that is, well, if your kid was going to start college in 2008, all of a sudden half their money's gone, right? Over the next year, or in 2001, or potentially with what we're about to see in the market, being at an all-time high right now. So I always thought that was a little bit strange that anybody would want their money that they're saving for their kids' education to be in something that's not guaranteed or not for sure. And they have no control over that. And timing actually really mattered a lot as far as that goes. So we're kind of, in general, we're opposed to what we would call one-use vehicles, or single-use vehicles. So 529 plans are designed for a specific purpose, and they can't be used for other things unless you get penalized for it, right? So we are more in favor of putting money into things that you have a lot more flexibility, a lot more control, and a lot more certainty as far as that goes. All right, let's go on to the next one, Taylor.
Okay. We have several questions in the chat, so we'll try to get through these before the end of the webinar. The first one is from David. Besides investing in oneself, what can a medical or graduate student do to begin building financial freedom.
I like that. And even the next one on there, I was just looking at that. Thank you, Taylor. So, and the next one from Mark is there a formula or a way to tell if you are actually following good financial principles and are financially free? So I think those two can kind of blend together. They're both kind of aiming towards financial freedom. And kind of what I would add into that first one, even as a medical or graduate student, to begin it, is what are the correct financial principles to be able to guide our decisions? We actually view it not just for our clients, but for us individually. When I make a financial decision, I run it through the principles. So, I mean, that's kind of the beauty of them, is to help guide my decisions and to be that check and balance on things, to make sure that, because I know that those are going to predictably put me in a certain position financially. And that takes discipline. It takes practice. And in that practice, we develop a better understanding of it, and then we're better able to follow it going forward. So I love that. I mean, I was just talking with a gal who's got a couple of years of residency left today, and we were talking about saving, and she doesn't have much money to save. And it's really not going to matter that much how much she saves right now, as far as the grand scheme of things, because once she's an attending, she'll save all that money like in spades, like very easily later on. But the reason she's going to start right now is because it's developing the discipline. And if she can learn that discipline now, when she starts earning more money, then she'll be able to apply that towards that greater thing and really make her plan take off like a rocket. So, and I think kind of going into that, how do you know if you're following those principles? We have to be able to identify them and then measure our decisions against them. Not the other way around, because normally we don't have a lot of things that we can really measure our decisions against. And that's why principles are valuable. We define financial freedom as when we have enough income from our assets that we don't have to work for, that's equal to what we make from our regular job. So if I have enough income coming in, passive income, if you will, that's equal to what I make for my job, then at that point, I'm financially free. I could stop working and still maintain my same lifestyle, right? It's actually something that we can we can see that whether I'm there or not.
Yeah, I love that. I love that. I think David has a great view on, because he sees he works with tons of people in residency, tons of physicians who are in residency and training. And he sees a big difference between those who come out with a huge amount of debt and those who don't. And I think he already has pointed out some of the major factors, right? Some of the major factors are, well, maybe you choose a less expensive college, right? Or maybe you choose, or maybe you're employing the principle of frugality, right? And you're establishing good habits right from the beginning. Even if you're saving just a little bit, you just barely have any to save, but you're just creating that habit that you're going to continue on. And before, I mean, we know from our experience working with a lot of physicians that when they get out of residency, there's this tendency to suddenly have this massive increase in lifestyle. And that's what buries them, like for a huge portion of their career. And probably one of the reasons, or the reason why most physicians don't become financially free, is because they suddenly are like, well, I need to live in this neighborhood, and I have to have this house, and I have to have my kids go to private school, and I have to have these cars. And suddenly this lifestyle eats up all of this advantage that they otherwise would have had. So somehow, that principle of frugality or suppressing lifestyle creep, I think, is super essential. And I would say is probably the difference between those residents who finish residency and aren't in a horrible situation versus those who are in a much better situation. Would you agree with that, David?
Absolutely. And I'm not a fan. I don't like the phrase, when among the residents, they're always told to live like a resident when you become an attending. That's the key. I think that's maybe it can work for a couple of rare individuals who are maybe really dorky in that way. I think for most of us, that's going to be really, really hard. But I think what is reasonable, it's like most diets, right? They're just like really extreme, and I don't think it's actually healthy for us long term either. but doing it in a measured way. And again, that's where the principles can be really helpful. And if we've learned those proper principles and we've started to develop that discipline along the way, then we can just take it to the next step when that income does increase. And this doesn't just apply to residents or any of that. It's, we all have different areas and milestones that we'll hit in our career where we earn more. And what do we do with that increased income? Right? What is our plan to be able to manage that properly? And when we have the right financial principles that help guide those decisions, it becomes a lot clearer with, whoa, I could spend that, or I could increase lifestyle, or I could move it over here and really put myself closer to financial freedom.
Yeah, let's address Mark's question a little bit more too, where I think maybe Mark, and you can post in the chat if I'm getting this correctly, but I think part of what you're asking is, where do you even find the principles, right? How do you even discover what those principles are that you should be following? And tell me if I'm wrong on that, but that's one of the major things. I would say that is the major thing that we do. I wish that I could say that most of the financial planning world teaches principles. But the reality is most of the financial world is exactly like the property and casualty insurance world, where they're just selling you something and it's based on price. And when we ask you, why do you have the coverages that you have? They don't know, right? There's no education that comes with it. So unfortunately, the people who should be teaching all the principles and promoting good principles aren't teaching principles at all. They're just selling products. They're doing exactly what financial institutions want them to do. In the meantime, the financial institutions are practicing the principles that they should be teaching. And so Unique Advantage, our purpose and what we do, we spend a lot of time as we go through go with our clients through the planning process. And it's really all about teaching principles, the whole thing. Because our goal is so that you walk away saying, hey, now I know. Now I have this filter that I can filter through all my decisions. I have clients call me all the time and say, I was looking at this investment opportunity and, I couldn't get you out of my head because you kept telling me to invest. In my head, you're saying, invest in the things invest in the things you can control. That's awesome. That's the best compliment I could receive, is that my clients are like almost bothered by the principles that they're taught, but that influences their decision and hopefully makes them make better decisions. I think you think about principles and the role that those play in your life in general. The reason none of you would go into a store and see something that you want and you just put it in your pocket and walk out of the store, the reason that thought doesn't ever cross your mind is because you have adopted a principle that doesn't let you do that. That your conscience says, hey, this isn't right. You're not going to, for most of us, that thought doesn't even cross our mind that we would even do that. Right. So, and then when we see anybody else do it, we're like, oh my gosh, I can't believe they just did that. They just walked out of the store, So that's the role of principles. I would also say that reading books from highly successful people, one of the genres that I read in books is I read books from highly successful people like Ray Dalio, like John Huntsman, like David, what's his name? David Wood, who started Hobby Lobby, More Than a Hobby. David Green, that's his name.
Andrew Carnegie.
Yeah, Andrew Carnegie's, Henry Ford. You read all these books and you're going to find principles that are very common among all of them.
Yeah.
I think we have time for one more, maybe.
All
or
right,
do we
we got
want to
one
hit?
more.
Do we want to hit the survey real quick? And that way, if
Yes,
anybody needs to jump off, let's talk about the survey again, and then we'll hit
Yeah,
one last
I just
question.
posted that in the chat, actually. But yeah, if you want to do the next screen, Kyle, there is also a QR code if people want to scan it. Please fill out this survey before you head out. Helps us know what topics to address next time and things that we could be doing better.
Awesome. Thank you. All right. One last question, Taylor. Which one?
Okay. This might be easier if you read this in the chat, Kyle, but I will read it out loud. So there's a specific question when you guys were talking about college information. they decided to go the community college route. They have $10,000 in cash to invest. So in 2 years, she will have more than $10K for the third and fourth year. Would it be better to put in a 529 or a CD for 2 years?
Cool.
Go ahead,
Well,
David. I'll let you start.
love hearing the community college route, right? It's like you took the council right away. It's awesome, right? No, that's terrific. So sometimes, like on those specific ones, it gets tricky without viewing the full plan. It might seem like that's, it's just this either or decision, but there may be something else within your plan overall that's far more substantial or urgent, really, that maybe we're not aware of. So just bear that in mind as we kind of navigate here. But I mean, some thoughts as far as that goes, just specifically without any other details on your plan in general. I mean, that's cool. Yeah, I think, if you put it in a 529 plan, again, it's most likely going to be in the market. Where do we expect the market to be in years 3 and 4 and when she's in college? It's going to be a maybe. It could go up, could go down, it could be the same, right? And do you want that to be going up or down or maybe, or at least in a CD, you know that it's going to be guaranteed. Rates on CDs aren't terrible right now. The benefit, I guess, to the 529 is if it does go up, you're not going to have taxes on it. In a CD, you would have taxes on that interest. Some other thoughts, you may even take out student loans for the 3rd and 4th year. While she's in school, you're not going to pay interest on those student loans. And then you can turn around and use the $10,000 to pay off the student loans, but it gives you an additional 2 years. So really you're looking at like a 4-year timeline. It's kind of a different way to look at it on there, but again, without looking at the full thing and kind of seeing all those pieces, it's a little trickier to give specific advice, right?
Yeah. I would just say we would bring it back to the principles, right? So
Yeah.
When you look at a 529 plan, is that a savings vehicle or is that an investment vehicle? Is a CD a savings vehicle or is that an investment vehicle? And what are the principles that are related to those things? So, the principles related to saving are totally different than the principles related to investing. For example, saving should be done automatically and systematically. Automatic means not thinking. You just make a choice and you save, and it's almost habitual, right? We're not trying to take risk in saving. Saving is liquid, it's guaranteed, it's accessible. Investing is different than that. We shouldn't invest without thinking, right? We shouldn't invest without knowledge. And we teach 3 rules as it relates to investing. The first rule is invest in what you know. Invest in something that you have an expertise in or that you're willing to become an expert in. Number 2, invest in the things that you can control or influence, right? So just like David was saying, the 529 plan, you have 0 influence over that. So, even if you knew everything about it, even if you knew exactly where the money was being invested, you have no influence over the outcome. Are you okay with that? I mean, that's part of the filter that you could create. And, I think for people's different people might be able to say, yeah, I'll make an exception here. I can't control this. But I know a lot about it. So maybe I'll make an exception and put the money in. But I think if you don't check any of the boxes for those rules, the reason Warren Buffett, he has a good quote. There's a good quote that he says. He says, the difference between successful people and highly successful people is that highly successful people say no to almost everything. And the reason they say no is because they have a criteria. And if whatever opportunity they're faced with doesn't meet that criteria, they're more than willing to say no. And that's why they're so successful. They just say no a lot. Most of the time they say no. Unless it fits their criteria for investments specifically, they just don't do it. And I've got some good stories about that too, but we don't have time for that today. All right, Taylor, take it away. Thanks, everybody. Want to thank you for joining, and hopefully you got some good things of value from tonight's message.
Thank you for the questions too.
Thank you all for joining. Quick reminder, please fill out our survey. And yeah, we'll hopefully see you next month. Our next webinar is on August 29th. So keep an eye out on our social media, on Eventbrite, on Instagram, Facebook, all those things. And reach out if you have any questions. We're happy to help. Thank you everyone for coming.
Thank you. Have a good night.
Thanks, guys. Have a good one.